My name is David Pope. I'm the Managing Director of Quantitative Research here at Capital IQ. It's my pleasure to introduce my fellow panelists here today. The topic of our discussion will be the current state and the innovation of quantitative research and quantitative investing. The recent environment has been somewhat turbulent for all types of investors, and I think today we'll have some insightful discussion about how quants are thinking and the direction that quantitative money management is moving. So I'd like to first define what we mean by quantitative investing. It's unlike what we were discussing earlier today. It is not statistical arbitrage. It is not high-frequency trading. It is really a disciplined, risk-controlled, factor-based, empirical approach with a turnover that's more or less in line with what you'd expect from a fundamental process. So that's sort of the framework in which our discussion today will be taking place. So at this point, I'd like to have our panelists, starting with Val, introduce themselves.
Yeah. Hi. My name is Vassal. I work at Glenmede Investment Management. We're headquartered in Philadelphia. In our team, we actually manage 6 different quantitative equity strategies, ranging from a large cap blend to small cap growth. We also do 130-30, and we also manage a long-short portfolio. We have taxable and tax-exempt clients, so we actually run tax-sensitive portfolios for them. And we also actually work and provide support to a fundamental analyst as well as fundamental portfolio managers. So we actually have kind of a little bit of a hybrid quantamental or whatever, in that we actually work with the fundamental analysts to come up with new ideas for some of our strategies.
I'm Matthew Rothman. I run the Global Quantitative Strategies team at Barclays Capital. We're a client-facing part of BarCap. We don't run any proprietary trading strategies, and we work primarily with other quants across the street, as well as fundamental clients. We have our own factor models, we have our own risk models, and we're constantly looking for innovations and ways to enhance them and help clients manage their own money. Thank you.
Yes, I'm Kevin Shea. I'm Director of Quantitative Research at Cadence Capital in Boston. We're a $5 billion U.S. growth manager. I just also wanted to say that some of these topics we've been talking about, I've had conversations with several of you in the audience for many years, and I just sort of see this as a continuation of that conversation. So it's good to see you.
Hi, I'm Janet Campagna. I'm the CEO of QS Investors, located here in New York. We are a newly started firm. We spun out of Deutsche Asset Management. We were the quantitative strategies group within that organization. We manage $11 billion in quantitatively oriented strategies, although we do blend fundamental insights into our strategies across a broad range of asset classes, including U.S. equities, global macro, and strategic asset allocation.
Thank you. So I think we'd like to start with speaking about the current landscape, and then, where possible, sort of folding in a discussion of where we see the future of the landscape sort of evolving to. It's no surprise to anybody here that the markets have been rapidly evolving over the last several years. I think managers of all disciplines have struggled. And I'm going to ask the panelists to discuss a little bit about how you're working to distinguish and position your investment process with clients and prospects. What do you see the competitive landscape looking like, and what product opportunities are you seeing either today or in the future? Val, maybe you can start.
In terms of, actually, we're kind of excited right now from where we are, given all we've been through the past couple of years. You had the August 07 Black Swan event. I think we've developed and learned some things during that period. And during the August 07, we realized that there are a lot of people making the same short trade, and that we had actually a couple of names in our portfolio. So we actually modified our screens to make sure we don't short the most excessively shorted names out there to prevent short squeezes. And the other thing that we have been developing over time is actually developing a top-down leading industry group model that helps us bias the portfolios in certain industry groups depending on where we are in the economic cycle. and the capital market cycle. The other thing we've done is we've had different models for shorting versus buy decisions, and we've added to our downside risk screens, which are some of these are qualitative measures to help potentially avoid blowups. Some of the tools we use are earnings surprise models, which we've developed in-house, as well as quality of earnings, even debt ratings are a consideration in some of our downside risk screens.
I certainly think Quant has gotten a lot of attention over the past few years, and as Val was saying, and I think we all know, August 2007 was certainly a wake-up call to a lot of people, and I don't want to belabor it too much, but I think we were really just the canary in the coal mine, and I think some of the problems and issues that people in our industry had around leverage and excessive leverage certainly we saw come later in the market that many other people experienced as well. And so I think what hit us just hit us early, and the rest of the industry was, felt it just a little bit later. In terms of where people are moving, I think we'll kind of get to more of these questions later. I hope it's a large part of the conversation, but I think it's really a terrifically exciting time to be a quant, conditional, of course, on survival and having any assets left at this point. But the world is really, in many ways, as we think about it, right, becoming more and more digitalized. There's more information that you can get today in electronic media and forms than you could ever get 2 years ago, 3 years ago, much less 10 years ago. And who benefits from that but the quants? Who's going to take all this new cool data that you're getting in a digitalized form and test it and implement it and put it into their trading strategies and work on it? But quants. The world is coming to us in many ways. I think we can probably discuss a lot of the ideas, hopefully kind of going forward. But there's so much you can do with text parsing these days. It's a real revolution out there, and you do not need to have these incredible programs that people had in the past. Just simple Perl script can get you a long way here, and any 22-year-old kid at a college can do Perl scripting. Heck, I can do Perl these days. So there's just a tremendous amount of, I think, really neat innovations that you can begin to have as the world just comes to us.
In terms of the market, I think, in fact, Matthew's done work on this in 07, the quant meltdown. A lot's been written on it. Leading up to then, for 6 years in a row, the same strategies, value outperformed growth. So whether you had a quant strategy, 1 year look back, 3 year, 5 year, 7 year, a lot of people were in the same crowded trade. Now that that's happened, the last 3 years, growth has outperformed in value. It's been back and forth. So I don't think we're poised for another one of these quant crowded trade situations again. So I'm optimistic about that. In the last couple of years, the correlations have been high, as people have talked about earlier today. Those have started to come down recently. Cross-sectionally, there's still a decent spread between the best and worst, so I think there's decent alpha opportunity out there. In terms of what we've done a little bit different, we've started to look at some of the industry group specific data items. There are another 500 items out there in addition to the standard 500 CompuStat items. We're getting ready for the XBRL data that's starting to come out. I guess in terms of not just data, what the data is, in terms of data handling, I guess I'd call it. Say, for instance, we're looking not just at a level of a PE, for instance. We're interested more in the volatility of the data. So a price to earning stock with something that's got more volatile E instead of a more stable E, I think that's something that we're doing that not too many other people I've seen have done out there. I guess so then lastly, I think in terms of analyzing the output, a lot of people are still using, or not still using, I mean, it's sort of the industry standard is to use a mean variance approach to optimization and a Sharpe ratio evaluation of the output. And I don't think that really captures a lot of how investors feel about 2 or 3 times more of the downside than the upside. So we use more of a semi-variance approach to looking at factors and a Sortino ratio to evaluate the output. So I think those are somewhat different than other folks in the industry.
I think that I look at this a bit differently in that I get concerned when we do put people into the camps of, well, here are the quants and here are the fundamental investors, and that that there's no way that we connect with each other. I think that most people fall somewhere along the spectrum, because I don't think that there are a lot of fundamental investors out there who don't look at risk factors, for example, or don't look at transaction costs in their strategies, or don't have some idea of the level of risk or tracking error that's in their strategy or their fund. And in the same way, quantitative investors who are taking the sort of approach that we are, where we're looking at really fundamental types of information and then looking to process it in very disciplined ways, stripping out a lot of the emotion, are not looking at sunspots or doing real high frequency sorts of trading. There's a real story to what we're doing. One of the things that I've found very interesting to be looking at over the last few years is understanding, people essentially don't change, right? We are still operating with the same brain we operated with about 10,000 years ago when it was fight or flight. And we react the same way to the market, very viscerally. We're either very fearful or we're very greedy, and we tend to go along that cycle, moving in and out. A lot of what we do is trying to say, what part of that cycle are we in? And therefore, what are the drivers of the market right now? What are people reacting to? If you're in the fear cycle, you're not really looking probably at valuation. And when you're in the strong part of the greed cycle, you're also probably not really looking at valuation. But you need to understand when the market is over or under reacting to certain types of information. And a lot of our research has been moving in that direction.
Thank you. Janet, I love your comment. Quant is sort of a catch-all phrase. I've always thought of myself and my peers as investors that use quantitative tools. So really that's what it's all about, and overlaying a disciplined empirical process on top. I wonder if we could switch gears here and talk a little bit about your process to the extent you're willing to share with us. And I wonder in what ways your firms are leading the way in innovation of quantitative strategies. So the world continuously changes, and there's inefficiencies that we're always looking for to benefit our clients. And so what sort of thinking are you engaging in? And what are your thoughts on how quant managers can become yet more effective in 2011 and beyond? So Val, maybe you can kick us off again.
Yeah, I mean, one of the things we've done is we've actually developed multiple type of models, one which are more long-term focused, looking at holding a stock for more than 12 months. But we've also developed some tactical models as well, looking at, what we call a short buy and a short sell model. And some of the factors or data we're looking at is actually looking at derivatives, option pricing, and options activity for some of the stocks, and also just the more weighting on technical factors, both in terms of short interest and interest behavior. And again, those are to help maybe time when we go into a long position, but also give us signals as to when maybe we should be leaving some positions as well. I mentioned earlier we've been doing some leading industry group indicators to help us bias a portion of the portfolio depending on where we are in the economic cycle. And what the data we use there is actually PPI data, which goes to a pretty extensive level of detail. You can probably almost get to a sub-industry group. And what's neat with the PPI data is it's available monthly, and you probably get a good signal of what revenues or costs are like before the company does its quarterly reporting, or that group does its quarterly reporting. So it gives us kind of an early maybe signals as to where to bias some of the sectors in the portfolio. We've also, and what Kevin spoke to, is looking at downside risk. When we do our optimizations, we're not just looking at mean variance analysis, but actually looking at semi-deviations or the risk of not achieving an alpha target, where the vulnerability is not making higher excess returns, where you're concerned about is being short an alpha target. So we've built the optimizations from that perspective.